Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So the markets have been all over the place last few weeks, last couple of months if you honestly. And what I have done today is looked around and found 5 different companies that seem to be undervalued according to Morningstar. Now some of these companies have gone up a lot since the beginning of the year. So since January of this year, they have gone up so much. Some of them are up about 50%. But you also have companies that are, this is high growth companies. So the non-high growth, growth companies. So we're talking about the consumer staples companies, the healthcare companies, and so on, have not gone up as much as these companies. So there are values there too. So I will be looking at that as well. Inshallah, I will share with you what I think. So a couple of companies that are trading almost to their 52-week lows, inshallah. But today is all about high growth companies. And you have to really be careful with this because some of these companies have very high PEs. And the reason is because we as investors think, okay, based on growth estimate, okay, what the analysts expect from these companies, we are willing to kind of bet on these companies doing really well. For that reason, we're going to pay a high premium for high returns later on. And that's why the PE is always very high for these companies. So you have to be really careful. But I'm going to give you the brief information about each one of the companies. And as always, I'm not a financial advisor. So you're going to have to do your own research and find out a bit more information. Again, you might completely disagree, and say these companies are not basically cheap at the moment. And that's absolutely fine. Again, like I said, I'm using Morningstar valuation to kind of give you an idea of where these companies are. And then you have to go away and do your own research. Like I've always said to you guys, I'm just sharing my journey here and some of the information that I found. Some of the companies that we're going to talk about today. In fact, I don't actually think I own any of these companies. Okay, the only non-dividend paying companies that I own in this portfolio is the Palo Alto Networks. It has gone up so much in the last few months and basically in the last couple of weeks. So I was planning to add another 5 shares basically in the next couple of months. But it looks like it's gone up so much, so I'm gonna have to wait for hopefully a pullback. And when these companies kind of pull back and they go down, they actually don't go down very, very quickly. So I might get another opportunity soon, but for now I'm just gonna wait. So this is the only non-dividend paying companies that I have in this portfolio. So let's get started with the 5 companies. But before we do that, as always, if you like this content, okay, please like the video, subscribe to the channel, and of course join us on the Patreon account where you get access to all of these things, including the Sharia compliant ebook, as well as the Discord access, inshallah. Right, let's do basically what we normally do here. And as you can see here, we got the ticker, we got the company, the market cap, economic mode, the price, so current price of this stock, the EPS, so earnings per share. We got the PE here, so current PE for trailing 12 months PE. We got the forward PE. Okay, forward PE kind of helps us to see basically based on the expected earnings where the price, where we think basically in terms of how expensive the company is moving forward. Price to earnings to growth or PEG ratio also helps us. It's something that was made famous by Peter Lynch. So anything below 1 is very cheap. Anything between 1 and 2, I always say is okay. So anything below 2 is actually okayish. Price to sales, again, similar sort of a thing to price to the PEG ratio in terms of what we're looking for, anything below 1. In terms of profit margin, we're looking for profit margin, we're looking return on equity, we're looking at the current ratio to see if the company has enough liquid assets that they can liquidate in the next 12 months to pay off any debt. Especially in this interest environment situation, these companies, we need to make sure they're not running to the bank or whatever they in terms of to borrow money to actually get into debt. So if something happens, the company has enough liquid assets they can liquidate within 12 months. Then we look at the free cash flow, and then we look at the total return in the basically last 10 years. Again, this kind of helps us where the company has been, but it doesn't help us moving forward. What helps us is the estimates from the analyst here, and if they basically what they think about moving forward. Again, this is based on the analysis, so it's again the human, they just estimation. So you're gonna have to also do your own. When you look at this estimation, sometimes you have to do your own margin of safety and think about it. Okay, Morningstar valuation, again another similar situation. They telling us where they think the price should be based on their valuation. Again, always have your 5%, 10%, 15% off margin of safety, and then the price where they think the price should be, inshallah. So Let's have a look. The first company is Salesforce. Salesforce is one of the companies that I used to own in my portfolio. I think this company in maybe 10 years, 15 years down the line, if the company stays consistent and focuses on the growth side of things and focuses on basically doing the best that they can, instead of the CEO trying to become some sort of celebrity, I think this company will become the next Microsoft. And I've always said this to you guys. I used to own it. I sold it, I think, when the price was about $185 per share. Okay, it's now $200, so it's not far off. It can potentially come down. But it has wide economic moat. Price right now is $205 per share. EPS, we're looking at $1.60, so they have a positive earnings. The current PE is 128, so this is very expensive, but the forward PE looks about 26, okay, right now. So 26 basically is way cheaper than 128 right now, so it seems cheaper moving forward. And then the PEG ratio is basically just 1.1, which is quite, tells us it's basically cheap, because the PEG ratio for growth companies, you always have to look at the PEG ratio more than the PE side of things. Okay, and price to sales is 6, so it's slightly higher than we want it. Profit margin is not much, because this company turned profit not long ago. Return on equity, again, is not much, because they're not returning a lot of that value back to the shareholders and so on. Free cash flow 7.56 billion, which is really healthy. Okay, total return we're looking about in the last 10 years, 15%, which is really good. Growth estimate for the next year, they're expecting 15%. After that, 26%, and then it's discounted according to Morningstar about 19%. $255 per share is where they think the price should be. Next company we're looking at is another company that we know, that's Mastercard. Mastercard is Sharia compliant because they don't deal with any of the riba side of things. They deal with basically the technology company that makes the transactions happen. They don't care about what the transactions are. They make the transactions happen and they get their cut. 375 billion market cap. It has a wide economic moat. Right now the price is about $400 per share. EPS is $10.67. PE right now 37. That's basically average for this company. I think if you look at the 5-year average, in fact, let me just have a quick look. I think that if you're looking at the 5-year average for this company, will be around that. So if we go to valuations and the 5-year average is 40. Oh wow. Okay, so it's actually, so it's higher than basically where we are now. Current PE though 32, and the PEG ratio of 1.35, so it seems cheap right now. Price to sales, we're looking about 16, which is a bit expensive from that side of things. Profit margin, we're looking about 43% right now. Return on equity 175% right now. Current ratio is above 1. Okay, so which is fine. By the way, the Salesforce current ratio, although it's below 1, they have quite a few free cash flow, so we can ignore that for now. Okay, free cash flow $10 billion right now. Total return in the last 10 years, we're looking at about 20%. Next year, the earnings expected the earnings to grow about 19%, 17% after that. 2% discounted right now at the time of recording. $406 per share is where the price should be according to Morningstar. Next one is a company that I used to own. I wish I never sold this company at the time when I sold it. But I took a little bit of profit. I think I just broke even at that point and I took the money. But it's gone up a lot since. I think I was sold like when it was about 400 something. Right now you're looking at about $560 per share. 240 billion market cap. It has a wide economic moat. Right now $560 per share. EPS about $11. PE right now 50, forward PE 33, PEG ratio of 1.96, so not too expensive. Basically price to sales seems side of things is too expensive right now. Profit margin 27%, return on equity of 34%. Current ratio 1.25, free cash flow 7.63, which is absolutely good. Perfect in terms of total return last 10 years, about 26%. So you would have made 26% every year for the last 10 years if you own this company, which is really huge. You beat the market basically every single year, and that's what you need. If you want to beat the markets, this is the type of businesses that you need to own. However, beating the market means that basically taking a little bit of risk, not a little bit, quite a bit of a risk, because you are actually buying companies that have a very higher multiples. Okay, 33% growth expected next year in terms of earnings, and then about 15% after that. 3% premium right now, so it's around that basically fair value price, which is 510. Right now is 504. So if it might come back down a little bit. Okay, so this seems cheap, but it's not too cheap, according to just about 3% premium at the time of recording. The next company we're looking at is Autodesk, 444.9 billion market cap. It has wide economic moat, $212 per share right now. EPS, we're looking at about $4, so another one that has a positive earnings. PE 52 right now. PE, forward PE, we're looking at about 28. PEG ratio of 1.57. In terms of price to sales, we're looking at about 8. Okay, profit margin of 17%, return on equity almost to 90%, current ratio just below 1, free cash flow of 2.19, total return in the last 10 years about 17%, growth estimate for the next year is about 13%, 14%, 15% after that for every single year for the following 5 years, and that's what they expect. Okay, 15% discounted right now, $247 per share is where they think the price should be. And finally, Dexcom is another company that's in the healthcare. I think they basically make equipment for diabetes and so on. $29 billion market cap right now. It doesn't have a wide economic moat, so anyone can get into that sort of a business. Price sell right now is $75 per share. EPS right now is just below $1, and PE right now 90. Forward PE of 61, so it seems cheaper moving forward. PEG ratio of 1.58, price to sales of 10, a profit margin of 11%, return on equity about 16%, current ratio of 2.42, which is absolutely fine. And free cash flow right now we're looking at about 466 million. Again, it's a small cap so company, so that's not a problem. Total return in the last 10 years though 27%. Growth estimate for next year is 30%. After that, 37% every single year. 18% discounted right now. $92 per share is where they think the price should be. And that there you have it. There's 5 different companies according to this. Okay, apart from Adobe, which is almost a fair value right now, all of them are discounted, have a massive growth expectations. Okay, that's just expectations and so on. In terms of free cash flow, they also seem solid and so on. Majority of them have wide economic moat, very well known companies, and they have a positive earnings, majority of them. So it will be interesting to kind of keep an eye on this in the next few months. And again, remember, if you do, I think it was a sales for one, let's go to actually Mastercard and just use this as an example. A year to date, this company is about 15%, but I'm sure Salesforce is up in the 50%, more than 50%. There you go, 52% up. Okay, so again, you have to really be careful because some of these companies, of course, they are great. Let's look at Dexcom and see how much is up for the year. Actually, down 34%. So that must be, hold on a second. So, this is in the 52-week low. So it's actually trading 52-week lows, which is interesting. Okay, that's interesting. Let me have a look at the other two. Yeah, Adobe 66%. So I knew that it's gone up so much since I sold. Whoever invested around that at the time where I had the company have made really good returns, mashallah. And Autodesk is only up about 15%. I say only up, but it's up 15% for this year. So there you have it. 5 different companies, all wonderful companies, but you just have to do your own little bit more research. In terms of Sharia compliance side of things, these companies are doing really well. Like 100% almost in terms of the business activity side of it. They don't have a much of a debt, they don't have a much of interest bearing securities and so on. So this is a really solid businesses generally. So always do your research. And like I said to you guys, I'm not a financial advisor, so just please always make sure you're doing your own research and so on. Well, I'm going to stop the video here. If you haven't joined us on the Patreon, please do so. It really helps the channel. Like the videos because it supports the channel as well. That's something you can do for free. And as always, I've got a few more videos coming up. I've got a couple of videos that you guys asked me to do in the last couple 24 hours, 48 hours. So I'm going to do them, inshallah, in the next basic today and tomorrow, inshallah.